Hello, my name is Lindsay. Thank you for joining today's Family Office Network's webinar series featuring AIR Asset Management. Before we jump into the presentation, I would like to briefly introduce our speakers today. Richard Beleutz, Chief Executive Officer. Rich is responsible for overseeing and directing AIR Asset Management's overall strategic growth and initiatives. He has more than 20 years of financial experience and has closed over $1 billion in transactions for companies and investment products. Scott Romanek, Managing Director of Sales and Marketing, is also joining us. Scott joined AIR Asset Management in January of 2018. With over 20 years of experience in investments and financial services, Scott's responsibilities include fundraising, implementation of strategic marketing initiatives, development of client relationships, and providing investor relations support to AIR Asset Management's investors. At the end of today's presentation, we will have time for Q&A. We encourage your questions, so please use your questions chat option on your screen to send those over so we can answer them accordingly. And with that said, gentlemen, I will let you take it from here.
Thanks, Lindsay. Again, Rich Beleutz, AIR Asset Management. AIR Asset Management is a longevity-based asset manager here in Chicago with over $350 million under management. We're an SEC-registered investment advisor founded in 2014. Today, we're going to talk about the longevity investing space and what it is and the attributes of it and how the current market has been affected by COVID. Start off with what is longevity investing. There's three categories that we consider longevity. First is the life settlements investment arena. A life settlement, and we'll get into some details on each of these throughout the presentation, but a life settlement is a purchase or sale of a life insurance policy in the secondary market for typically from seniors that don't want or don't need that policy. There's a life settlement market that is also non-seniors. We'll address some of those nuances. The second is the annuity and structured settlement market. That's a market where folks have life contingent payments through a certain period of time or through the rest of their life that they no longer want or need, and they are looking to monetize those. And then the third area that we focus in on is life insurance and longevity-based lending. And so we'll talk about each of those components. So first off, a lot of investors that I speak with wonder, how do you position longevity within a portfolio? So I want to talk a little bit about that. Longevity investing is traditionally a subset of the private credit asset class. Private credit is really come into its own as a identifiable asset class since the credit crisis and the dislocation of banking as being the primary source of credit finance. So in private credit, you have several categories. You have the senior debt market, that's broken into levered and unlevered. You have subordinated capital, distressed credit, and specialty finance. Longevity is a subset of the specialty finance. Aviation finance is another example. Litigation finance is another example. The reason we like the specialty finance arena within private credit is it tends to have the highest degree of non-correlation to the broader markets, being both a credit investment and a niche and esoteric investment class. Longevity investing is also sometimes, especially life settlements, is sometimes placed in the alternative fixed income arena, although it's not a true fixed income type of investment. It's got a lot of the attributes because there can be some type of distribution arrangement through some of these investments, and there's a principal protection feature through the payment of a death benefit through a rated insurance carrier. So that's how typically the asset class is considered from a diversification standpoint. I'm going to turn it over to my colleague, Scott Romanek, who's going to go into more detail about what life settlements, annuities, and lending opportunities are in the space. Scott.
Thanks, Rich. Again, Scott Romanek, Managing Director of Sales and Marketing for AIR Asset Management. So I'd like to talk to you a little bit about just broadly about this space and why this space actually exists. In many ways, I know for myself, when I got involved in this asset class in this capacity 3 years ago, it was something that I had heard of, but really didn't know the details of it. And as I investigated it a little bit more, I found it incredibly interesting. Obviously, one of the main drivers, I think, certainly from an investor standpoint, is the non-correlated return stream, being driven by mortality, having no tie to traditional asset classes such as stocks and bonds. And that really intrigued me, and it does certainly intrigue and perk the interest of investors. So I'd like to talk to you a little bit about kind of the evolution of this asset class and why it really started to begin with. First off, I'll kind of go in chronological order. This asset class really sort of started back in 1911. There was a Supreme Court ruling called Grigsby versus Russell. What Grigsby versus Russell determined was that a life insurance policy is considered an asset. It's considered property. Therefore, it's transferable. So you do have legal precedent on this going all the way back to 1911. Let's fast forward to the 80s. What happened in the 80s is, I'm sure most of the attendees are aware, we obviously had the unfortunate AIDS crisis that came upon and kind of swept the world and the United States. What happened back then was that many of these folks who had been diagnosed with the disease were looking for any way that they could finance experimental medical treatments. And what many of them found was that they could actually sell their policies to acquire some liquidity to fund these treatments. These at the time were called viaticals. And a viatical, by definition, is less than 24 months to live, less than 24-month life expectancy, as we refer to it. So that was really kind of where this asset class took off, and people started realizing that there was value in these policies. As we fast forward to the 2000s, we got to, let's refer to the credit crisis of 2008. Around that time, you had all the major investment banks. I'll name a few: Credit Suisse, Deutsche Bank, Goldman Sachs, all participated in this life settlement marketplace. I will emphasize it was a different marketplace back then. It was highly unregulated at the time. It is currently regulated in 46 states. Back then, it was not regulated in that many. And back then, predominantly, one of the main differences was there was a lot of leverage that was employed in the space, where groups such as some of those investment banks were using leverage in terms of premium finance. And what they were doing was they were essentially funding premium payments for policyholders, some of which the policyholders, they actually did not have an insurable interest in these folks, which is referred to as stranger-owned life insurance. Currently, this is against the rules. Back then, it was not. So we've evolved to where we are currently today. Again, asset class being very, very highly regulated, 46 states. And what's appealing about this from a policyholder standpoint? So a life settlement transaction is basically, it is the purchase or sale of an unwanted or unneeded life insurance policy. I'll give you some statistics. There's 68% of the people who enter into this transaction are either overinsured or simply can no longer afford their premium payments. The old misperception, and maybe rightfully so because of how this asset class has evolved, back to the 80s when people were funding these medical treatments, was that these policyholders are simply selling policies to do kind of last wishes or for treatment, that sort of thing. It's really not the case. As time has gone by, what's happened is Seniors, Americans in general, and predominantly seniors, as they get into a fixed income sort of situation, really realize that they might be ill prepared for retirement. And I'll give you a statistic on that. 80% of Americans have 1 year or less in salary saved up. Shockingly, 40% of Americans have none whatsoever. And that becomes problematic as you get into your twilight years and into your 70s and on a fixed income type of situation. So these folks are desperately in some ways looking for a way to find liquidity for many things in their life, funding long-term care being a very serious concern. There may be folks, there may be attendees on here right now who understand that, or who have aging parents or grandparents and are encountering that in their own personal lives. This asset class provides these folks that liquidity. There was a study done in 2014 by the London School of Economics that found a life settlement transaction on average provides a policyholder up to 7 times what the cash surrender, thank you, Rich, for switching the slide, up to 7 times what the cash surrender value would be to an insurance company. So it's very advantageous for them to do so. We actually, just this past week, obtained new data based on a global life settlement conference that happens in Geneva, Switzerland annually. The current data on this is actually roughly, it can be up to 10 times what the cash surrender value is. We've found in the recent data that on average, policyholders are receiving 21.5% the face value of what their policy is. So if they have $1 million death benefit, i.e. face value of the policy, they can receive up to $210,000 for the policy. So again, very attractive, and it's very attractive for investors as well, because you are, and this goes into the socially responsible component of this asset class. You're providing these policyholders, predominantly seniors, much needed liquidity. So this asset class is really now being viewed as a socially responsible investment, which is very important. I think that a lot of investors certainly, not only in achieving these attractive non-correlated returns, but knowing that you're helping somebody and being responsible probably provides an added benefit to them. So it again, to emphasize the fact that the asset class has evolved, it's highly regulated today, and it's really providing a nice opportunity and an option that insurance companies do not give these policyholders. I did want to point one more thing out, and I know we do have another slide on this, but there's $21 trillion of life insurance that's in force in the United States of America. That's more than the rest of the world combined. Of that 21 trillion, up to 90% of that will lapse without the insurance company having to pay a benefit. Now, much of that is term insurance, but nonetheless, there is whole life and universal life, which are the foundation, universal life more so, of the backbone of what a life settlement transaction and the type of policies that are transacted. So it just goes to show that, you know, this does, it really is advantageous for policyholders and provides them that way to monetize that. So I'd like to talk a little bit about how this actually transacts and how policyholders go about the process. So as I mentioned earlier, 46 states this is regulated. What you do have is in these states, you have what you call a life settlement broker, a registered life settlement broker, and they're regulated by the state insurance commissions. What these brokers will do is the brokers will go around to financial advisors, trust attorneys, any sort of financial planners, any kind of really a fiduciary for clients, and they'll go around and they'll ask, do you have a client in your book of business that would be eligible for a life settlement? Usually what these folks do is they'll look at their client base and they'll say, you know, as a matter of fact, Bob Smith could be a very good candidate for this. Bob has multiple insurance policies and would really doesn't need the one of them. As these folks get older, obviously the premium payments become more expensive, particularly when these people develop impairments. Those premium payments can become more expensive, and hence they're looking for a way to recoup that cost. So then the policies are then presented to the broker, who will then go to what we call a provider. Provider is basically the buy-side broker in a transaction where the policies are brought to them and there's analysis that's run, i.e., as you can see from the slide, the underwriting. So the policyholder has to they have to submit a HIPAA release form, which allows analysis of their medical records. From there, what happens is the number one critical key component to determining the pricing of a policy is determining how long that person is actually going to live. And that's based on assessment of the medical records. Some asset managers in this space do this differently. Some use proprietary modeling to determine that life expectancy. Others will use independent medical underwriters to remove any biases on impairments and really trying to determine if someone's being misrepresented or underrepresented as far as their life expectancy is concerned. So that's where the underwriting process goes on. Then what happens is the valuation and pricing. These providers that facilitate these transactions will then go ahead and they will present these policies to asset managers and funds, investors in this space. And basically what happens is the investors themselves, the asset managers, will start bidding on these individual policies, much like a real estate transaction. And when the policies are presented like that, usually what happens is the managers in this space that buy these policies will typically look for a certain IRR that they want to establish from purchasing the policy. And then again, it's a bidding process. Usually the highest bid will win. Not always the case. Sometimes it could be like selling your home, where someone may offer you full price for your home, but there's contingencies. And one of those contingencies may be that it's a 60 or 90-day closing. In this asset class, you could actually have someone that may offer you a little bit less for the policy, but they can close quickly. So there's different factors that determine how a policy is actually sold and at what price. But that's just a general overview of that. And then the closing process is really, again, very much like a real estate transaction, where there's very, very detailed documentation that must be completed in order for the transaction to be in force. And hence, any errors and the policyholder themselves must turn over any of the beneficiary rights to the policy to the investor who purchases the actual policy. So that's a little bit about how the transaction process works. This slide here gives you an example really of the overall marketplace. As I mentioned earlier at the top of this, there's 20, maybe 21 trillion of total life insurance that's in force in the United States. As you can see, 100+ billion lapses every year only by seniors. There's obviously more than that lapses if you add in more people other than seniors. But what this really kind of depicts is the fact that there's two markets that comprise this life settlement market. The secondary market, which was what I was referring to earlier with the brokers and the providers. And that's where a life insurance policy is sold for the first time by the policyholder. So that is where Mr. Smith will decide to sell his policy and settle his policy in the secondary market, where policies are sold one by one. We then have what we call the tertiary market. The tertiary market is where investors will trade with other investors. This is the marketplace where you see some of the most prolific asset managers in the world are active here. I'll give you a few examples. Apollo Group, Oaktree, Blackstone, even Berkshire Hathaway. are all participants in this tertiary marketplace. The tertiary marketplace is where policies are transacted in bundles, if you will, in portfolios, not transacted singularly. Collectively, these two marketplaces currently are roughly about $20 billion in death benefit annually. So that's key to note. That's what the face value or the overall aggregate death benefit of the policies would be. And it's almost split evenly between the secondary and tertiary market. Sometimes it can obviously skew one way or the other. There could be 8 billion in one market and 12 billion in the other. You get my point. But what's happening in this asset class and what the projections are, you can see by 2025, we're looking at an increase of death benefit to about 60 billion, so about threefold. There's notable reasons for that. Number one, you have an aging baby boomer population, and those baby boomers now are within 3 to 5 years of where the median age for a life settlement. Those folks will be getting to that very shortly, 3 to 5 year period where the meat of those people are going to be eligible to transact life settlements. So you have that. You also have what's going on is a very large educational process in this space. Well, what do I mean by that? Remember when I was talking about how transactions are done in the secondary market via brokers who talk to financial advisors, trust attorneys, financial planners. Slowly but surely, word of mouth is getting out. You also do see there's a direct consumer market. Many of you, now that I mentioned this, will notice this on cable news networks, where you see the senior couple that has the golden retriever on the lawn, and the wife says, we no longer needed our insurance policy. And that's an example of the direct consumer market, where people realize, and maybe that could be an option for me and be an attractive option for me. And then they will call an 800 number. So you've got direct to consumer going on. You've got word of mouth by these fiduciaries of clients. You also have, interestingly enough, what's going on in the regulatory market is that states are being required by insurance commissions to notify policyholders. Remember that 90% lapse rate, that if their policy is in jeopardy of going into lapse, that a life settlement is an option for them. And that alone is really providing these people with knowledge of this asset class. And what they're doing is they're uncovering an asset that many of them had no idea that they even had. To our estimates, we understand that maybe 25% of eligible seniors who can transact a life settlement are even aware that it's an option for them. So there's a lot of room for growth there, and that's what speaks to that $60 billion number and the increase of the capacity in this space.
Thank you, Scott. So we're going to shift the conversation to, what are the risks and what are the return opportunities within the life settlement marketplace? And this is a chart that illustrates, and it's just an example, but it illustrates just maybe one view on how that risk can be broken down in terms of potential return. So the market rate, we'll talk about the policy IRR, which is really the market rate in life settlements. And that market rate has changed over time. Depending on how you measure that market rate, there's a lot of different ways you can take a look at it, but I'll just use one kind of general methodology to illustrate its movements. So in 2007, for example, the market rate may have been 9%. In 2009, it may have gotten up to 18.5%, and today it might be, 11, 12% here. I use an example of 12.5%. Maybe it's come up a little bit this year. And this market rate is basically a present value of the accumulation of potential cash flows that come in from a policy over time, which is how it's modeled. It's similar to like a Black-Scholes model. There's some probabilistic projections that is utilized through a software program. There's two main programs that utilize it. So the first and the biggest risk in the space is for policy is the mortality risk. You don't know the maturity date, and is detailed information as you can get through the medical underwriting, and as much as you can correlate it to actuarial probabilities. There's a lot of variability in when any individual is going to pass away. One of the biggest mitigants to that, obviously, is when you build portfolios. Those portfolios tend to have characteristics that become more predictable through the law of large numbers. But on individual policy, you can say maybe, I don't know, 5% is assigned to that mortality risk, and that just has to do with your methodology of estimating the mortality through your statistical simulations, through maybe aberrations in the underwriting, and some of our competitors out in the marketplace will try to arbitrage the mortality risk, and they'll try to, as Scott alluded earlier, they'll have proprietary underwriting, and they'll really try to manage that as their big alpha driver. So that's the mortality risk, and some of them just accept the actuarial methodology for what it is and focus on other ways to generate return. The second biggest risk in the life settlement space is what's called other risks, which includes the regulatory risk and just the uniqueness of the asset class. There's things like stranger-owned life insurance, where how was the insurance policy underwritten, and did it follow the guidelines when the policy was underwritten? That kind of esoteric nature of the asset class and just all the kind of other things associated with it add to about 3.5%. You throw liquidity risk. This is a level 3 asset class, and there's a lot of open-ended and closed-end fund structures out there, but investors have to, and as Scott alluded to, there is a robust secondary market for life settlements out there, or tertiary market for insurance, but you still got a risk premium of a couple percent, based on the equivalent credit quality, because in times of distress, call it depressions, great recessions, times of COVID, liquidity can dry up in the space, and investors need to be aware of that. Credit risk is obviously another risk that is typical of life settlements. And by the way, all this applies to the annuity and structured settlement market as well, with just different values that are assigned to them. And the credit risk is just a standard, swap rate kind of versus the risk-free, and then obviously you have a rate for the risk-free. It's changed since May a little bit, but that gives you just a breakdown of kind of how we view risks to be priced in the life settlement market, through the law of large numbers, through diversification, through professional underwriting. Those are strong ways. Good trading counterparties, etc. Fund structure design. Those are ways that you can mitigate the various risks. Next, I want to talk a little bit about the COVID and how it's impacted the life settlement marketplace. This has been an odd year, to say the least. For everybody, for many reasons. Obviously, at the election, but probably even more disruptive is the global pandemic, limits on travels. Scott and I are in the same kind of bubble, so mask wearing and all the change of how business is conducted has affected the life settlement market. So initially, how it's affected the market is when the pandemic really hit in Q1, you saw larger redemptions occur in open-ended fund products. You saw a reduction in the secondary market activity due to social distancing distancing, you may have seen a slight uptick in the volume of mortalities. As the summer came through, you saw some changes. To the marketplace, you saw the mortalities come down a little bit. Mortalities that had come in were with tended to be with the smaller policies. And the reason for that is there's a wealth effect to mortality. The wealthier individuals had more resources to do proper social distancing and obtain health care if they needed it. Also, you have a little known effect amongst the senior population in general, that in times of distress, whether it's depressions, great recessions, war, the senior population mortality tends to actually decline. One of the reasons we believe that's the case is because they're more needed for their wisdom and resources, etc. However, as the effects of that stressful event carry on or wane, what has tended to happen historically is the toll of the stress of those events have accumulated, and there's been a mortality bump. So but overall, from just a general standpoint, the impact on mortality, you can say, has been minor or immaterial at best, just because of the fact that a very small percent, a very small percent of overall seniors have mortality anyway.
Yeah, I'd like to interject a point, Rich. Thank you. And this is based on, as I mentioned, this is fresh data that came out of last week's Global Life Settlement Conference in Geneva, Switzerland. And initially, when COVID hit back in March, obviously it's very difficult. It was new and incredibly unexpected. But there were a couple of these independent medical underwriters that had tried to really kind of prognosticate how this was going to affect this asset class and policyholders in particular, because this asset class disproportionately represents the older segment of people in the United States, those being 85 or older. So they kind of made their assumptions around that. And what they had said was, initially, at 275,000 US deaths, we're at, I believe, 250,000 as of today. At 275,000 deaths, what they had estimated was that we were going to likely see 1 in 1,000 policyholders were going to be affected. So a little bit more, and not minimizing the number of deaths by any means, obviously that's not what I'm implying, but the impact on these policyholders that comprise life settlement portfolios is pretty negligible. They also had estimated that these people were going to be 13 times more likely susceptible to death as a result. What they have found, and again, this is preliminary, this is all kind of ongoing data, is it turned out to be about 6 times. So half of what they initially projected. Rich sort of alluded to this, but I'd like to clarify it if I may. You've seen more effect on what we call the smaller face policies, which is anything under $1 million or less. The reason is it's basically implied that the people who have smaller face policies might not be as wealthy as those who have larger face policies. Those who have larger face policies, $1 million or greater, what we refer to as that wealth effect, either have better access to healthcare and or are more, I would say, cognizant of their own health and are, take precautions. So we did see in these smaller face policies a little bit of acceleration in mortality, but not so much in the larger face policies. So just wanted to clarify a few points.
Yeah, thanks, Scott. And so we got through kind of the trend to the summer. We're in, just to summarize, where you had higher than average redemptions from investors in, basically the large open-ended vehicles in the space. You had maybe a slight acceleration in mortality and small face policies. Truly, kind of like a negligible impact to the overall mortality experience in the space, maybe a slight uptick. And then you saw a slowdown in secondary market activity. You saw a carry through of tertiary market activity. And then, kind of the rationale for a lot of the early redemptions in the space was people showing up liquidity for operating businesses. Then you saw in the kind of the second half of the year, you saw maybe some additional redemption activity in the space that was due to maybe opportunity. Maybe folks wanting to invest in distressed deals. The open-end market tends to have a correlation with the broader markets in times of distress. So returns have come down across the board. Open-end products, obviously closed-end products where there is no liquidity pressure, they've continued to perform or even outperform in the space. And you've had some of the biggest tertiary buyers in the marketplace pull back. So you've seen overall, we think, a decreased amount of liquidity in the space in 2020. Although you do have, because of the non-correlation of the returns, you do have a lot of capital that is continued to pile in and is even accelerating. So you've had a situation where the life settlement market, I think I talked earlier about how the life settlement marketplace was maybe 9% market rate in 07, up to 18.5% in 09, and maybe down to like 12% currently. So you've seen a situation maybe where it's raised a little bit because of some of these dislocations, and you create an interesting situation where you have a lot of new capital flowing in the space, and you have a lot of really good buying opportunities. And so we think that regardless of what happens, in the pandemic, short of maybe a global depression catastrophe that just saps up all liquidity, that 2020 is shaping up to be a pretty good year for the space because of a lot of the churn in the portfolio. So good buying opportunities, a lot of fresh capital. It's really a buyer's market right now, and that's probably going to flip at some point next year. Back into the seller's market. So it's just a real nice time to be entering the space at a period of time when the market rates have been coming down. So from that perspective, those are some of the kind of the news and notes that we've seen from impacts from our contemporary situation. We're kind of getting towards the end of our planned presentation period. There's our team. So I want to move this into the Q&A portion. So we'll open it up. So if you have questions, please let them rip. Appreciate your attendance here. And
thank you, Rich and Scott. I appreciate that. Yes, to our attendees, using your questions chat option again to submit those questions. I'm just going to dive right in. First question, gentlemen, from Diego. What kind of discount rates does the asset class have now, and have they evolved over time?
So I think I covered that. The discount rate. I don't know, maybe around 12% currently, and it was as low as high single digits. Back in pre-credit crisis era. And that was an era where you had a lot of policies that were being manufactured through stranger-owned life insurance, and you had a ton of leverage in the space. You have a lot of banks doing premium finance, and you had a lot of global investment banks that had life settlement desks. And so you had, through those life settlement derivatives and those life settlement desks, you had a ton of leverage in the space as well. The space currently is not levered. So it's in a much a lot of the investors are permanent capital investors. So you're not going to see, in my view, the same whipsaw of market rates that you saw in the Great Recession. In fact, you're probably going to see a very small bump in movements because of the fact that the space is much more institutionalized today with much stronger infrastructure and counterparties. than it was in 2009.
And Rich, can I elaborate on that for just 1 second? I want the audience to obviously have an understanding of how these, discount rates, what moves the discount rate. So Rich has mentioned the credit crisis, and I kind of alluded to that earlier in the evolution of this asset class. Back when these, pre-credit crisis, you had these large investment banks, Deutsche Bank, Credit Suisse, Goldman, to name a few. What happened back then was, there was obviously, they were using leverage extensively to buy these policies. There wasn't a tremendous amount of supply back then, frankly. So the discount rate, because there was such an appetite by these institutions to buy these policies, limited supply, discount rate was in high single digits. I think we can honestly say safely it was 9%. What happened after the credit crisis and credit being pulled was all of these investment banks and a lot of these larger investors were forced to sell policies. And so they flooded the marketplace. And with no buyers and a significant number of policies that needed to be sold at distressed levels, the discount rate went from 9 up to 20. Then what happened was you obviously had this settling down, if you will, and this, the regulation coming into the space and the institutionalization of the space. The discount rate slowly from 2009 to where we are today has gradually trended lower, because what you've seen is an orderly process of people wanting to acquire policies, a limited number of policies. And as that appetite of these institutions has increased and increased and increased, people are willing to pay more for policies, hence the yields have come in a little bit. So that's how the discount rate is driven.
Great, thank you. I do believe you did touch on this next question, but I would like to kind of ask all of them. How has the liquidity of the life settlements market, has it evolved over the pandemic?
So yeah, I think we covered that one pretty thoroughly. And just to summarize real quick, is liquidity maybe got reduced, depends who you talk to, maybe by a third, maybe a little bit more. It's temporary. I think a lot of it is some of the big tertiary buyers. We know they have cash because we know who the players are. I won't name them here. And they have committed fund capital. So I think they're just waiting, for a good opportunity, maybe the first quarter. Some of the big players are revaluing their one of them specifically is revaluing their portfolios. So they may want to wait till that revaluation is done to come in and do some good portfolio purchasing. So we know that liquidity is coming in, we just don't know when. So we think next year is going to be pretty robust. So that's how I'd answer that.
Great, thank you. Next question from Charlie. What is your portfolio's breakdown between the 3 segments, life settlement, structured settlement, and lending? And how do those segments differ in regards to return and risk?
Yeah, so the first one on we have different portfolios, so I'm not going to, this presentation is not about our specific investment structures. And so, that's something we could talk about offline, not in a public forum like this. But I can certainly address how each of them have different risk return profiles. So we'll start with life settlements. Right, we use the 12% as the market rate. That's the gross IRR that the average transaction comes. The spreads are call it high single digits into the 20s plus. So it's a pretty wide range of stuff that you're buying, and the stuff that you buy has different liquidity profiles and different characteristics and so forth. But in life settlements, and I went through that breakdown. So I think I covered kind of what the main risks are and what the mitigators are. But in life settlements, it's mortality risk is your biggest risk, with liquidity risk being up there, and then the third risk is a credit risk. The one thing I would add on the credit risk side is there's never been a valid life insurance policy in force in the U.S. since the 250 years or so that the life insurance industry has existed here that's failed to pay a death benefit. So there have been insurance companies that have become insolvent, and every time that an insurance company has become insolvent, they've managed to transition those books of business to solvent insurance companies Those obligations are super senior in the capital stack, number one. And then number two is every state has a guarantee fund that acts kind of like an FDIC, where it would provide some or all of the death benefit in case there ever was a situation where the government decided they did want to let an insurance company go fully under. I don't think that they would ever do that, and they never have. And the reason is those, they collect a little piece of every premium payment. Those state, insurance companies are the insurance commissions. And that money is funneled right to the general obligation or the general budget of those states, and those are unfunded. So the states would be on the hook to come out of budget to cut those checks. So they're always, in my view, going to just transition those books to healthier insurance companies. And typically those, the mortality data is strong. It's usually that the holding companies are mismanaged. Like for example, when AIG went under, it was their insurance company that cut the first check alongside the U.S. government, and they maintained their A+ rating throughout the entire fiasco after the credit crisis. So that's the life insurance piece. Next is structured settlements, and I can talk about why we pair structured settlements with life insurance. The return profile is a little lower in life contingent structured settlements. Call it anywhere from the mid single digits into the low double digits. In terms of the return profile, but the assets pair very nicely. And the reason is when you buy a life settlement, it's like a negative coupon bond with an undetermined maturity date. You have a cost of care. You're buying a liability that you have to fund with the premium payment every month. With a structured settlement, you're buying an income stream that disappears upon a mortality event. So you're paying money and then getting a check every month, unless there's there are things with delayed starts that you get for bigger discounts. But you still have conceptually you have a premium check that comes in every month versus paying out a premium check every month. And so when life settlements are paired with structured settlements, it really matches your cash flow very nicely. And it also acts as a form of mortality hedge. And so the mortality hedge, right, with life settlements, you're short mortality. With annuities and structured settlements, you're long mortality. And there's different aggregation plays as well within both of those spaces that act quite nicely. You can buy them one at a time in secondary markets. You can package them kind of like you do in the mortgage markets, and you can sell them off in bundles in the marketplace. So there's some good trading opportunities. The third is the life insurance-backed lending component. And there are a lot of private equity or private credit opportunities in the space, and those are just private lending opportunities that are available. And if you're collateralizing insurance or annuity policies, then what you're doing is you're obviously you do it at a loan to value ratio, where you have collateral that you like to own, but you're getting a fixed return, usually low double digits. So that becomes an even safer, bet, because you're not relying on a mortality event to pay your coupon. You have a portfolio of assets that are worth more. So that's kind of how I'd cover that question.
Great, thank you so much, Rich. Let's see here, moving on. Jason would like to know, what makes AIR different from other firms managing life settlement funds, and how does it source policies? And are there medical professionals on staff?
We don't use medical professionals on staff. We believe that that inserts biases into the process. So if some of our competitors do that, so what they'll do is they'll try to play a mortality arbitrage, where they'll look at the actuarial numbers and they'll place bets. And one bet might be there's a string of impairments that they believe has a faster mortality profile than the actual numbers play out. The problem with that is then in order to really have that bet play out, you need a bunch of those policies, because you want the law of large numbers on your side. So you need to diversify and get a large number of that same impairment pool together in order for it to play out. but then you impose different risks, because if you do that, and then there's a medical development that helps that basic impairment pattern, then you could have that trade go the other way. The other thing that happens is when you have an impairment view, is that you would probably be willing to pay more for that policy than anybody else, because you believe that there's a death benefit and you have a proprietary model that values that more than maybe the marketplace. So if that trade plays out, right, and you hold that policy to maturity, then you can potentially get that reward. But if you're in an open-ended fund structure, or even a closed-end fund structure that needs liquidity at the tail end of its life, and you have to sell that policy, and whoever's buying that policy doesn't recognize that same thing that you recognize, you're going to be selling that at a much deeper discount than you bought it at, and you could actually have significant losses. And we've seen iteratively in the marketplace, we've seen some competitors run into that problem when they have proprietary underwriting. They pay too much for policies, and then they have liquidity issues and they have to sell them. It could cause for additional losses within the fund.
And Rich, can I want to expound on that a little bit. I'll give the audience an example of a trade where someone actually thought that they were going to out actuary the actuarial tables, which we think is an incredibly flawed methodology. There was a fund years ago that thought that tall, overweight men with diabetes were misrepresented in the actuarial tables, that they were actually going to likely pass away much sooner than they were reflected to based on their impairments. So they loaded up on those policies. What they failed to realize was that statins were on the way, and that eventually that trade blew up, because what you had was you had extension of life, which is the #1 risk in this asset class, is that the life expectancy is extended. Now, I can't speak to other funds, and I'll generally speak about our fund, but one of the things that we do is we automatically assume life extension. And what we'll do is we will factor in on certain levels what we call a stress testing that determines if that person's life expectancy does exceed certain levels, that we can still either have a profit on the policy or a break even on the policy. So I think that's something that we do a little bit differently. Again, we're relying on these, as Rich said, we choose to employ independent medical underwriters to remove those biases. There's some funds out there that may have medical staff on their own team. That's great if they feel that works for them. But I'll give you an analogy. If you take 5 doctors and provide them the same policy, you're going to get 5 very different opinions on how long that individual is going to live. You provide that same policy to 5 actuaries, you're going to get within a tight grouping of how long that individual is going to live. We prefer to view them actuarially as opposed to taking a medical stance on policies.
Fantastic, thank you. We do have time for just a few more questions here. This question does have a few in place, so if you need me to read them again, that's totally fine. Are periodic distributions made or not made? Is most of the performance due to realized or unrealized appreciation? And does the fund seek higher or lower face policies?
So as I mentioned earlier, we're not going to answer fund-specific questions, and this is really not designed for questions about Air Asset Management or questions about any of our specific funds. But there are, so I can talk, really the purpose is to talk generally about the asset class. But I can tell you that there are different fund structures out there. I'll maybe talk a little bit about the fund structures out there. So you have open-ended fund structures, which are hedge fund structures. They typically charge a management and an incentive fee. They'll have quarterly liquidity. Typically, they'll have some type of lockup period, 1, 2, 3 years. They'll have notice periods. It's anywhere from 90 to 180 days. They generate liquidity through trading, which is the realized returns. They also generate liquidity through mortality. So that's typically how the open-end hedge fund structures work. Then there's the closed-end or private equity fund structures. They'll tend to have anywhere from a 6 to a 10-year lifespan. And what they tend to do is they have a subscription period. It might be a year to 3 years, where they'll call in capital. They'll buy life settlements in pools. They'll aggregate to a larger pool, and then they harvest mortality. Maybe some of them will do some opportunistic selling along the way. Most of them don't redeploy. Some of them maybe have a redeployment period. And then at the tail end of the period, then they'll go to the life settlement market and sell out whatever policies are remaining. And even in closed-end fund structures, you'll have a blend of returns that come from trading, which is, tend to be capital gains, short and long term, and then mortality income, which tends to be ordinary income above your cost basis. So those are a couple of the fund structures. I mean, there are competitors out there that use note products and holding company structures, and there's private pools, and there's balance sheet investing and so forth. So there are some other fund structures as well.
Great, thanks, Rich. Last question that I think we're going to have time for today is from Jim. Do the institutional investment consultants generally support life settlement?
So I'll take that question because I work with a lot of them very closely. It's interesting. That's a great question, Jim, actually. Thank you for kind of identifying that. What we find with many of these large consultants is, I like to refer to it as, is the dog wagging the tail or is the tail wagging the dog? And what I mean by that is, do these consultants actually recommend life settlement strategies to their clients? The clients being foundations, endowments, public and private pension funds, those sorts of institutional type investors. Or are the clients bringing the idea to the consultant? Typically what we find, and I had a call last week with one of the largest consultants in the country, they usually rely on the client coming to them with an idea. And if there's enough appetite, it's not just one client specific, unless in fact that client may be sizable. They don't just rely on just one client coming and saying, hey, this looks interesting, we prefer that you vet it, because obviously their time is at a premium, and there's many different strategies out there to look at and asset classes to look at. So you do find that these institutional consultants are aware of the asset class. I think that the overall consensus is that it's very interesting, some ways misunderstood by these, particularly maybe some of the public pension funds, because they are maybe concerned a little bit about the headline risk. But there is a lot of corroborating documentation and literature, if you will, that shows and gets them a little bit more comfortable with that, as we were talking earlier about the SRI component to life settlements, that socially responsible aspect, and how it is advantageous, for these policyholders and investors. So I guess that's a long, circuitous way of me saying that consultants are aware of it. There is an overall interest. They rely on more of driven by client demand, which slowly but surely is becoming more prevalent.
Thank you so much, gentlemen. It was a pleasure having you join us today. To all of our attendees, I will be following up with you. If you had any other questions for the AIR Asset Management team, I would be more than happy to get you in direct contact with either Rich or Scott. I hope you have a great day, everyone, and we'll talk soon. Thank you.
Thank you, everybody.
Thanks, Lindsay. Thanks, everybody.